Why is the FTC looking at Subway? Hello, this is Jonathan Mays, Editor-in-Chief of Restaurant Business, and in this week's episode of A Deeper Dive, I speak with John Gordon, a restaurant consultant, and we talk about Subway. I have John on now and then, and today we talk about the FTC's decision to look at the proposed sale of the sandwich giant to Roark Capital. Now, Roark is a big owner of restaurant brands. It owns restaurant chains of all kinds, and with the acquisition, its brands that include Dunkin', Arby's, and notably Jimmy John's will be responsible for nearly 13% of all limited service chain sales. So I talked with John about this and why the FTC would be interested at all in the restaurant space. We chat about how weird this move is. The federal government almost never looks to block restaurant acquisitions. In fact, we don't know of one. We also talk about the impact this will have on Subway and its franchisees, and we chat about Subway's upcoming requirement that its franchisees accept digital discounts. We're talking Subway on A Deeper Dive, so please have a listen. All right, I'm here with John Gordon. John, welcome to the podcast.
I am delighted to be here. How are you today?
I am okay. John, you've been in the industry for a while. Have you ever seen the FTC take any interest whatsoever in a restaurant merger?
No. I did a search on their website over the weekend, and I could not find any.
Yeah, I don't recall any. I mean, part of the issue, I think, is that for the most part, most restaurant mergers are just never that big, comparatively speaking. Like, I think if you ever look at the 100 top mergers of the year, there's never a restaurant involved. Never. And the biggest one in history in the U.S., I believe that was the Dunkin' deal.
Yes.
The Inspire Brands Dunkin' deal. The biggest one globally, I think, was the Tim Hortons deal, the RBI Tim Hortons deal, if I'm not mistaken, or the Burger King Tim Hortons deal that created RBI. So they're never that big, comparatively speaking. It's not like these $100 billion deals that they have in like whatever technology and banking or anything like that. So it's never really captured the eye. So what's notable about this FTC Subway thing is suddenly we have, is now we are starting to get interest from the FTC targeting. What do you make of this? What do you make of the FTC's interest here?
Several things. I mean, first of all, they have to look at it. Okay, their staff is limited, but I reviewed their procedures actually in terms of what they do, and their review mandates all the way back to the Clayton Act, which is embedded in our law for a long time. And their mandate essentially is to look at the potential for competition building. And the Clayton Act, which is embedded in federal law, intends to root out competition at its infancy. That's what the federal law is. Now, of course, how that is interpreted and how that forced over the decades varies. Okay. This restaurant case is complex. What has made this what is going to make it difficult is, first of all, there's a lack of data. Okay, looking at the regulation and their operating procedure, they speak of things like revenue. Well, there's not that much revenue really reported. There are things like units that are reported. So the FTC is going to have to develop proxies for revenue as they go down that pathway. So the point I'm making is that as we know that Roark is complex with 6 different cells of restaurants, and so the analysis is going to be complex. You've got of the group that we care about, or that they might care about, is Arby's, Jimmy John's, Schlotzsky's, and you've got a whole group of other restaurants that really aren't on point. Okay. The other issues to think about here is that obviously Subway is huge. In Subway's franchise disclosure document and in its franchise agreement, it actually speaks to the kinds of brands that it is worried about from a competitive standpoint. And I can read them off quickly, but I think I have them memorized. It speaks to the brands that are serve sandwiches on bread. Okay, for example, and it lists off a couple of other brands, for example. So Subway itself was worried about direct competition itself, and as we know, and as you have documented extremely well during this 8-month M&A shopping cycle, and now a further
it's longer. It's like 11 months.
11 months. Okay.
Yeah, it started in January. It's 11 months.
Well, yeah. Well, that's right. I was going to say, and the review cycle, which is going on now, and we really don't know how long the review cycle is going to go on. It could go on a lot longer. Okay, and it looks like it shall. There's no indication right now how long the FTC review cycle will go on. That's the best intelligence right now. This has drawn, a lot of attention, and there's a lot of risk for consumers. There's a lot of risk for franchisees. There's a lot of risk for staff. I want to specifically mention, John, that in the review of the operating procedures, that franchisees and like parties are not mentioned in the FTC review documents. However, employees are. Okay, that's of note. And then of note is, as any good procedure, there is a section for all other. Okay, so if the FTC runs across interesting or salient factors that tend to affect competition, then they can flag that in their review. So they have a factor for best judgment.
Mm-hmm. So I think the day is going to come, for what it's worth, that there's going to be a restaurant chain that tries to make an acquisition that's that makes itself too big. Now that's probably a long ways off. Because the restaurant industry is still loaded with all kinds of competition. In fact, we were at Starbucks last week, and what they'll tell you is that their competition is the bakery across the street. And it's not really Dunkin' so much as it is, that restaurant down the street, the bakery or the coffee shop down the street. So they say their competition is at the local level. Now, how much you want to believe that is up to you. But anyway, it's still a relatively competitive business. But it's also relatively common for companies to get, to build up dominance in their market over time. And in the sandwich market, Subway actually just a few years ago had more dominance than it would if assuming this deal goes through. It would have more dominance than it would today if you add its sales today plus Jimmy John's, which tells you more about how much sales that Subway lost and how much its competitors have gained in those years. But so they have 42%, those two combined, Subway and Jimmy John's at 42%. I looked at this of the sandwich market, for chain sandwiches. By comparison, McDonald's today has almost 47%. Yes. Chick-fil-A has 41% of the chicken market. By the way, that's actually pretty incredible, given that it wasn't that long ago. Both of us can remember it wasn't that long ago that KFC was much larger than Chick-fil-A, and Chick-fil-A now has 41% of that market. Taco Bell has a larger market of the Mexican market, a larger piece of the Mexican market that Subway plus Jimmy John's has at 43%. And then you got Domino's, which has less than 20% of the pizza market. I guess my point is, it's hard for me to look at the level of, some of these other chains and how much dominance they have in their specific market when compared with what Subway, what Roark would have, what a combined Jimmy John's and Subway would have of the sandwich market, which is what you've got to count. Because, a lot of Roark's ownership is well beyond that particular market. And includes some casual dining. It has, in Buffalo Wild Wings, it's to your point, it has like Dunkin', it has, like if you got Focus Brands, you got all that stuff over there. It's really, it's hard for me to envision why this particular deal would trigger an FTC investigation. It just doesn't scream superior dominance to me.
On the competitive side, I see that. I agree with that. I do see, however, that the deal is an extremely risky one.
Sure.
The risk, really, John, as we all know, is to the guests actually, and it's to the franchisees. And it's to the workers. If this merger explodes already, and I do want to point this out as new news, is that the Subway DAI has already mandated that the U.S. franchisees adopt the coupon or the digital coupon discount pricing that many that the marketing group advertised for weeks and months via coupons and via television, which many franchisees, a unknown number but a significant number, have ignored and have told customers that they weren't accepted.
Yeah,
have been mandated. So this has now permanently lowered the U.S. franchisee cash flow. Okay, I don't have a number. No, whatever number that DAI told the investors, the analysis process is now false because the franchisees are even worse off. So that means that the deal economics is potentially imbalanced going into the point where Subway DAI has to begin paying interest and debt after the acquisition finally closes.
Yeah. First off, that's not new news, actually. That was in September. We reported that in September, that Subway had established a deadline for December 28th.
Okay.
That franchisees had to accept these digital offers.
Right.
And what the digital offers are, and that's probably in some respects, we could go this entire line of questioning, but essentially, Subway runs probably the most aggressive digital ads that we see. I could probably go on the app right now. But they were running often buy one, get one free or buy one, get one half off. Sometimes they're running some extremely aggressive deals on their apps. Corollary to this is that unlike, say, McDonald's, which also runs actually quite aggressive deals on its app. If you ever go on a McDonald's app, it's very worthwhile to look at the discounts that they'll give. But McDonald's doesn't usually advertise on television that they're running, hey, we're going to give you one free Big Mac if you buy one at the regular price. Usually their deals are but they've got all sorts of deals. You got buy 1 foot long, and right now buy 1 foot long and get one at half price.
Yes,
and they advertise it. And a lot of Subway franchisees have pushed back very hard on it, and many of them do not accept digital offers or coupons. And now that this deadline is coming up, and it's less than a month away.
Yeah.
They're starting to get real antsy. That's actually what somebody described that to me recently.
Yeah,
And
and by new news, I know you, I know you reported it, but what I really meant to say, I misspoke slightly, is that it it may be new news for Roark, in terms of what the pro forma is now for the U.S. franchisee base, and so it's a new challenge going in for 2024 for whatever the U.S. franchisee uh, 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 population will be as a result going forward.
right. But so I mean the interesting element of that discount, which was one of my next questions, is they've been pushing, again, they've been pushing their deals more aggressively on their app. And again, you can find Burger King, McDonald's, all kinds of companies do a lot of discounts on their app. On balance, I would prefer it that way than say a dollar menu, or
Right.
certainly another $5 foot long, because at least the customers are giving you something in exchange. So, when you offer a discount on your app, it's more likely that you're going to get at the people who are looking for a deal, as opposed to, and you're going to get somebody who is generally a loyal customer, as opposed to blanketing the world with a bunch of, BOGO coupons, paper coupons, which Subway also does very aggressively, I might note. And in those cases, or you have a broad-based discount, which tends to capture a larger number of customers. And with a coupon, they ain't giving you anything. If you're just using a paper coupon, they're just using a paper coupon, and stuff like that. So, I mean, I guess my question is, we're starting to see franchisees really push back. So McDonald's have pushed back on that app a little bit. You see some complaints there. Subway franchisees are probably the most vocal group, which is probably why we're seeing the mandate now. You ever, I mean, what's your thoughts on something like that, absent the Roark deal? I mean, the Roark deal is what the Roark deal. If you're buying Subway, by the way, you're buying a company with franchisee health questions, and they know it going into it. To me, but what do you make of a lot of this pushback we're starting to see now on franchisee apps like this?
Well, sure. I mean, it's natural and expected, and I'm just sorry that there was not more visibility by organized groups of franchisees to this issue while the deal was being analyzed, so that there was more attention to it. As you know, DAI was very secretive regarding the U.S. franchisee sales and profitability numbers. They came up with all kinds of different ways to display the U.S. sales numbers by increment, but there's never been a real good display of the entire U.S. Um, uh, Subway sales display. They were good in terms of displaying back to 2012 and 2014, but that's not really a realistic economic base. I remember some of John Chisney's interviews with you, but the the reaction I got is, so what? So those aren't relevant bases anymore. They're relevant to Subway in its way, but they're not relevant today. The Subway franchisees have a very powerful franchise agreement that bounds them in, and they are in a real pinch, and they have limited means for reaction. So it's a very difficult situation. I wish they would have spoken up sooner.
No. So, do you have any sense of what a prolonged FTC investigation might do here? Like you're talking, if I recall the Cisco US Foods deal a few years ago, and that took 1.5 years. And ultimately it wasn't resolved. How it was resolved is that Cisco backed out.
Right.
And ultimately backed out of the deal because the FTC started winning. Assuming that it's a year, it's hard for me to imagine. I don't think, the case here is nearly as cut and dried as it was with Cisco and US Foods. As I've noted in the outset of the podcast, but you've got to assume that this is a several month delay at the very least. Do you have any sense of what this does to the deal at all?
Well, I looked at the parameters of the deal. If I'm not mistaken, it's a $360 million breakup fee. Number one, this period of time gives John Chisholm and VAI time to go in and make some alterations to the supply chain model and other things, other attributes of franchisee operations, not only in the United States, but internationally, where they feel that there may have been a overstatement of the EBITDA, which was reported at $750 million per year as the number that was given to Roark as the baseline forecast. And there was some concern early on by industry observers that number was pretty high. So if that was the case, then this delay does give Subway some time to button up the hatches, so to speak, and find synergies, if you will, in order to get things straightened up and find some synergies, so that when they do begin paying debt, that they are able to actually improve the real cash flow, the real EBITDA line. Mm-hmm. So that's a good thing for them. Now, for franchisees or franchisees being serviced by the supply chain, or for and I've been thinking about this a lot, although we don't have a lot of information about it, the international franchisees that are being supported by the international distribution agents. I just wonder what are going to be the terms of support going on for someone that, Mr. Chisholm is justifiably proud of the new 15 or 16 franchise agreements signed during his watch. But what kind of service are those distribution? I keep saying distribution because I've been thinking a lot about distribution lately. What kind of service are those new franchisee, multi-unit franchisee owner operators going to receive once they sign up? There have been long-term thoughts, as you know, in the United States, to basically disable all of the so-called DAs or distribution agents in the U.S. Is that going to be the trend internationally as well? So that's a very interesting question, and something that the new international franchisees need to know about. And it's those kind of synergies and tweaks that will be going on during this time period.
Yeah. Yeah. Well, I guess we will see. My guess is that they get rid of them because that's what their stated goal is to.
Yeah. Well, in the US it is, sure.
Now I guess one last comment, which is my prediction here, is that the FTC probably negotiates a deal with Subway, or Roark, actually. And that one of two things happens is that they agree, Roark somehow agrees not to combine the supply chain, probably is one of the big things that they'll look at. The other thing they might do is decide to take Inspire Brands public, which is probably, one of the likely scenarios over time is that they take Inspire Brands public. The market is probably looking a little bit more favorable for that to happen next year. So that would be my prediction here. And the easiest way for Roark to get out of this is to do that. Take Inspire Brands public, setting the stage for an ultimate exit. And that would be my guess. Now, who knows? But we'll see. John, this was fantastic. Really appreciate you joining me this week on the podcast.
Interesting as always. Thank you for having me.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons. Artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. And you may subscribe on Spotify, Apple Podcasts, or anywhere else you get your podcasts. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.